Good morning, children. So today I am going to explain you some more on journal entries. There are some special journal entries are there for adjustments. Return, RETURN, return. Return is here. There are two types of return. The goods return. Sometimes once the goods are sold by the businessman to a customer, the customer may return the goods to the businessman. So this is called as sales return. Sales return is goods returned by customer to businessman is a sales return. And it is also called as an return inward. Sales return, the goods returned by the customer to the business house is called as an sales return. So another is purchase return. The businessman, they also purchase the goods from the supplier. They also purchase the goods. When the businessman, due to some reason, defective or whatever may be the reason, the goods sometimes are returned by the businessman. Once it is purchased, afterwards sometimes it may be returned to the their supplier, called purchase return. The goods purchased are sometimes returned to the supplier, maybe whatever may be the reason, the goods are returned to the supplier by the business firm is known as an purchase return. The goods are purchased, the businessman, they also purchase the goods to sell in the market. So when they purchase the goods, and sometimes the goods purchased are not according to their specification, sometimes it may be damaged, so are not up to the mark. So those goods are returned to the suppliers. So that is called a purchase return. So in this way, there are two types of return. One is purchase return, another is sales return. So this way there are two types of return: purchase return and sales return. One, we have a discount. One is discount received, another is discount allowed. Discount received is given by the discount receipt is given by here the supplier to the businessman. When the supplier to whom the businessman has to pay to other. So if the creditor is giving the discount to the businessman, creditor means to whom the business has to pay. So discount received, the farm may have to now pay less amount. So that's called discount received. Discount received is an income of the farm. So discount received. Suppose a farm has to pay 10,000 to X. Now X has given 500 to the farm. Now farm has to pay only 9,500. Farm has to pay actually 10,000 is the farm is owing to X. Farm has to pay to X 10,000. But now X has given discount to the farm. That means farm receive interest 500. That means farm do not have to pay 500 now. So this type of discount is called as a discount received by the farm. Discount received, and it is income of the farm. So it is to be credited. Discount received is to be credited here. So another, we have a discount allowed. The farm allowed discount to the farm allows discount to the customer. So a farm has to get from Ram rupees 5,000. Now farm has given 500 to discount to Ram. Now farm has asked only 4,500 from Ram. So Ram has to pay only out of 5,000. Ram has to pay only 4,500 to the farm. That means business is giving discount to the Ram 500. So this is discount allowed by the farm to its customer. So this is discount allowed. Discount allowed is always debited. Discount allowed is always debited. And discount received is always credited. Discount allowed is a loss for the farm. It is the expense of the farm. It is a nominal account. It is always a debited because it is expenses, it is the losses of the farm. But discount received is the income of the farm. It is a gain for the farm because farm has to pay less now. As I have given the example, a farm has to pay 10,000 to X. Now farm has to pay only 9,500. 500 farm do not have to pay. 500 is a gain for the farm. So it's a nominal account. The discount received is a nominal account. It is to be credited. So I will also give you the journal entry for discount received and discount allowed. Compound journal entry is there. So also sales return and purchase return. So again we have one more is opening entry. Opening journal entries. You have heard about the opening journal entries. So I will also give you the note after this. Okay, please go through my notes also on opening entries. So opening every year, at the end of every year, the accounts are closed. Each and every accounts are closed. All the nominal accounts are closed. Nominal, I hope you have understood what is nominal accounts. All the nominal accounts are closed. All the real accounts are closed. All the personal accounts are closed. But real nominal account are permanently closed by transferring the amount to the trading account or profit and loss account. Real nominal account are permanently closed, but real account and personal account are not closed. The balance are carried forward to the next accounting year. Like building account, the building of 1 year will carry forward the next year. The machinery of 1 year will carry forward in the next year. The furniture of 1 year, it is not permanently closed. The furniture that will be used in the next year also, and again it will be subsequent until it goes on. The personal account, to whom you have to pay, from whom you have to receive, all these accounts are not closed. If amount is due in this year, if this year is not paid by the customer, they will pay in the next year. You should not close this type of accounts. Suppose if you have to pay to any party, if you have not paid in this year, you will pay in the next year. It is not closed. It will be carried forward in the next year. That's why the assets and liabilities, these accounts are not closed. Like if you talk about the traditional approach, that means real account and personal account, and these two accounts are not closed. It is carried forward in the next accounting year. But only the nominal account from the traditional concept, if you talk about the modern concept, nominal account means expenses and income. These accounts are closed at the end of the accounting year by transferring their amount to the profit and loss account. So that's why nominal accounts are closed at the end of the year. Each and every nominal accounts are closed. Nominal accounts are salary account, purchase account, sales account, so insurance account, advertisement account, wages account, carriage account, all the expense and all the income, discount received account, discount allowed account, commission received account, commission allowed account. All these accounts are closed at the end of every year. Each year, every year, all these individual accounts are closed by transferring this amount to the trading account or profit and loss account. But real account like building account, machinery account, furniture account, personal account like Ram account, Mohan account, Syam account, Hari account, all these accounts are not closed. Bank account, all these accounts are not closed because their amount will be carried forward in the next accounting year. So this is the opening. So next account, when they are carried forward in this assets and liabilities, that means nominal accounts are closed. The assets and liabilities of last year is brought forward in the next current accounting year. So when we start our accounting year in the current financial year, we have to carry forward last year balances of assets and liabilities are to be brought in the opening as an opening entry. That's why here how to pass the opening entry. The rules for passing the opening entries is all the assets are debited. All the assets, individual accounts are debited. Cash account debit, machinery account debit, furniture account debit, building account debit, stock account debit. So all these assets account are all debit. Individual account are debited. Cash account debit, bank account debit, stock account debit. So all these individual account are debit. Debtors account debit. Debtors means due from customers. Debtors are debit. Machinery is debit. Furniture is debit. Land and building debit. Plant and machinery account debit. All these assets are debit. And what is credit? All the liabilities are credit. Like creditor account paid, bills payable account credit. So that means in the journal entry, debit and credit must always be equal. The debit and credit must always be equal in the journal entry. You have learned this one. Always in the journal entry, rules of journal entries, debit and credit must always be equal. But in this way, in opening entry, if the debit and credit does not tally, all the assets are debit. Suppose all the total of asset is 1 lakh, all debited. Cash, bank, debtors, building, land and machinery. All this, if you see all the debit entries are 1 lakh, and all the credit are suppose only 20,000. Creditor and bills payable, only two items are credited, and 5 items are debited. So all the assets are debited, and the 2 liabilities are less. The debit is 1 lakh, and credit is only 20,000. That means in the credit there is 80,000 short. That is the balancing figure of that amount. 80,000 is the capital account you have to find out. In this way, you have to find out the capital account by the debit minus credit, and asset minus liabilities is capital. From here, we have to find out assets minus liabilities is a capital. So debit, all the assets are debited, all the liabilities are credited. Sometimes this debit and credit may not be equal. So what we have to do, If debit is more, you have to write in the credit side. In the credit side, two capital account balance. So debit is 1 lakh, credit is 20,000. So 1 lakh minus 20,000. Asset is 1 lakh. Asset is 1 lakh. Liability is 20,000. 1 lakh minus 20,000 is 80,000 is the capital account. So asset minus liability is capital account. So this question also you have to remember very. You have to be by heart with this entry. Assets minus liabilities is always a capital. This is the accounting equation. Assets minus liability is always a capital. So asset is 1 lakh, liability is only 20,000. Asset minus liability is capital. So balancing figure is capital. So this is about the if that asset side is more, debit side is more. But you may say now, sometimes what happens when the liability side is more, if the credit side is more. If the credit side is more, please remember carefully. Please note down. If credit total is more than the debit total, so in the debit, that means credit total is more, now credit total is more. Suppose the credit total is 1 lakh, but debit total is only 20,000, 80,000. Credit total is 1 lakh. In the credit side 1 lakh, but debit side is only 80,000. 20,000 is shortage in debit side. So debit side is sorry, you have to write the amount in debit side 20,000. 20,000 is shortage. Shortage amount you have to write now in the debit side. Because credit side is more. Credit side is 1 lakh. Debit side is only 80,000. So 20,000 is the goodwill. The balancing figure 20,000 is the goodwill. So this is the balance in the debit side. So if you have not understood, I will again show you after this. I will show you the sum, practical sum also in opening journal entry. Please go through this video, okay, till the end. So you will be, I will show you the opening journal entries also. So now we'll go to the practical of opening journal entries. Let's see the entries on the goods written by Ramesh. So in the goods written by Ramesh, so this is Ramesh is a customer. Customer has written the goods. So let's pass the journal entry. So what goods written by Ramesh? The journal entry is sales return account debited to Ramesh account 500. So this is the goods written by Ramesh entry. Sales return account debited to Ramesh account. In this sales return you can also write return in word. This sales return you can also write return in word. Okay. Now let's go to this goods return to Hari. Goods return to Hari. Goods return to Hari. This is a purchase return. This is a goods return. We are returning goods to Hari. To Hari. Yeah, by Ramesh and to Hari. You see, by Ramesh means goods return by Ramesh means sales return. But goods return to Hari means purchase return. Purchase return is here. Hari account debited. Your goods return to Hari. So this is the journal entry for goods. This is a sales return. Sales return is also called as an return inward, and purchase return is also called as an return outward. Purchase return, you see, purchase return is also called return outward. Return outward. Okay, please note this. Purchase return is also called a return outward, and sales return. And sales return is also called as a return inward. Return inward. So sales return is also return. Sales return is return inward, and purchase return is also called as a return out. Return outward. Return outward is purchase return, and sales return is return inward. So this is the about the journal entry of returns. Now children, let's see this question. Question number 22. Question number 22 here. Cash in hand is 11,200. Bank is 2,57,000. Cash in asset. Bank is also asset here. Asset here. Bills receivable 68,800. Asset debited. Jairam is a debit, means debtor debited. Rajkumar is debited. 48,080. Office furniture is debited. Asset. Trade stock in trade is asset debited. So Daulat Ram credit means liability. You have to pay to Daulat Ram. Amount due to Daulat. You have to pay to Daulat Ram here. Hari Kumar creditor means credited means you have to pay to Hari Ram. Hari Ram you have to pay, and bills payable you have to pay. So which you have to pay the liability. Now let's see this in the compound, how compound journal entry is passed. Now all the, as I said, all the assets are to be debited. So in the journal entry, all the assets are debited means here cash account is debited. Cash account is debited. Bank account is also debited. Cash is 11,200. Cash is 11,200. Bank is 2,57,600. Now we have bills receivable. Bills receivable account is also debited asset 68,800. And Jairam is given debit here. Debit means debtor, customer, from whom you have to receive money. Please note down, Jairam debit means Jairam is a customer. You have to receive money from Jairam. Ram Kumar is also debited. Ram Kumar debited means from Ram Kumar you have to receive 48,080 rupees. You have to receive from Ram Kumar. Ram Kumar is a customer. You have to receive from Ram Kumar, due from Ram Kumar. So office furniture. Office furniture is asset debited 52,800. Stock is debited. Stock is also asset here. Stock is 4,16,000. So all asset side is completed. Now let's see the liability side. Liability side is only 3 items are there. That is also less here. Now 2 liabilities are here. Credit side are Daulat Ram is credited. How much credited here? Daulat Ram is credited by 1,74,720. To Hari Ram is credited means you have to pay to Hari Ram. How much you have to pay? 2,16,920. So amount payable to Hari Ram is credited here. Okay. So all the assets are debited, all the liabilities are credited here. Daulat Ram you have to pay 1,74,720. Hari Ram you have to pay 2,16,960. Again bills payable you have to pay. One bills payable is there. It's a liability which you have to pay the bill at the time of maturity. You have to pay this 80,000. 80,000 is also liability. Now see that asset side is more, debit side is more. This is a debit side and this is a credit side. So debit amount credit. So this is a debit side. Debit side is more than the credit side. Debit side total is now I've done total here. Debit side total is 8,62,480 and credit side total is only 4,71,680. Now debit side is asset side. If you see the asset, if you see the capital, now balancing figure is what is the balancing figure is now we have to write here 2 capital account. This we have to write it ourselves 2 capital account. From here this amount will come. This total minus this total of this asset, debit side total asset. Or the asset is equal to how much? The total of asset is 8,62,480. You please add this total. Okay, the 1, 2, 3, 4, 5, 6, 7 items I have done in hurry, so I may be mistake also. Please you also check it. Total is coming. Asset side is total is coming 8,62,480 and liability side. Liability means credit side. Credit side total is coming here. 4,71,680. Okay, so this is the credit liability. Asset side is 8,62,480. Credit side is 4,71,600. This one I am doing rough. So what, that means asset minus liability is what? Capital. How much the capital now? 3,90,800. Assets minus liabilities. Assets minus liability is a capital. So asset minus liability. This is assets minus liability is capital. So how we got capital here? By balancing figure. How much capital? 3,90,800. So this one we got it by balancing figure. By balancing figure. This is the capital we have found by ourselves by calculating it by using the accounting equation. Assets minus liability. All the debit assets are debited, liabilities are credited, capital credit side is more, credit side is less than the debit side, so debit side is more, so asset minus liability is capital. So total of asset is 8,62,480 here. The total of liability, this total 1, 2, 3, 4, 5 item. 1, 2, 3, 4, 1, 2, 3, 4 items total is 4,71,680. This is credit side. This is debit side. Debit side is all assets. All these debit side are all assets. And credit side 1, 2, 3 item. Capital we have. Capital is afterwards we found it. So in this way, this is a 1, 2, 3 item total is 4,71,680. So asset minus liability is the capital. So this is accounting equation. So this one. So now this is journal entry. It's completed here. This is journal entry. This is date column here. But journal entry. Journal entry. This entry is called opening. Last year asset and last year liabilities brought forwarded. So being asset of last year, you can write narration. Assets and liabilities of last year brought in current year. Current assets and liabilities of last year. Assets and liabilities of last year brought in the current year. So this is how we do the opening journal entry. So, but if sometimes credit side is more, then you have one will be here, debit side will be here, goodwill. If credit side is more, you will get a goodwill here. So this is how we write a opening journal entry. I hope you have understood. If there is any doubt, please text me. Okay.